Are we on the verge of a massive market crash, or is this the beginning of an epic recovery that could send stocks soaring? Well, there's one guy out there who manages $650 billion, and of course, my kitten Alberta, who are going to answer that question for you in the next couple of minutes. Now, the guy who's managing $650 billion is called Thorsten Slock. Sounds terribly serious. He's a partner at Apollo Global Management, one of the world's largest private equity firms. And he'd been warning that there is a 90% recession chance. And he's just flipped. Why has he flipped and what has he flipped to? That's what we're going to learn in the next couple of minutes if you stick around. Now, if you're genuinely serious about your portfolio beyond the doom and gloom headlines, you might also want to learn how people like that, how the guys on Wall Street are actually selecting stocks in this kind of a precarious market where some of the market is doing insanely well and, well, 90% of it just isn't. So if you want to learn that, I've actually got a 15-minute free masterclass for you where we share all the stuff that I learned from my Wall Street mentors. It's completely free of charge, part of a mission to make 1 million people financially free. So check that out, felixprehn.org/get-free, first link down below. Now, when someone who oversees hundreds of billions makes a move like this, it's probably time to pay attention. So in this video, I'll break down how this shift could impact your investment strategy, discover which stock sectors are likely winners and losers in this recovery. Now, let's rewind to earlier this year. Slock, the chap with the $600 billion, was sounding alarm bells about something most economists feared: stagflation. And for those of you who don't know stagflation, it's an economic nightmare scenario where you get high inflation combined with a slow economy, rising unemployment on top of that. It's particularly nasty because traditional policy, like what the Fed does, for example, it doesn't work. If the Fed raises rates to fight inflation, it makes the economic slowdown worse. If they cut rates to stimulate growth and create jobs, well, they make inflation. And Slock's warning centered around tariffs. When El Presidente Trump announced sweeping tariffs in April, this guy didn't mince his words. He said, we're gonna see stagflationary shocks. He saw them as a double punch, making everything more expensive while also slowing down the whole economy. His prediction: if the high tariffs stayed in place, there was a 90% chance of recession in 2025. He forecast that GDP growth would slow to just 1% in a bit. Inflation would hover around 3%. Unemployment would rise throughout the next year. Now, we have seen unemployment rise. Inflation is kind of a little sticky. And all of this created the dramatic sell-off that we saw in April, where the S&P 500 dropped like 20% in just over a month, the fastest decline since COVID, by the way. So global markets crashed as investors priced in the possibility of this madness as, well, they called it not madness, they called it a voluntary trade reset recession. VTRR, that's an acronym for you here. But then something interesting happened. And let me know in the chat, by the way, if what I'm describing so far is landing with you. It'll be helpful for me to make these videos better for you, right? That's what the whole point is. Just pop a one in the comments. Now, Trump paused the tariffs for 90 days on April 9th, and the markets rallied dramatically. And by June, the S&P had recovered to new all-time highs, which we're all enjoying. And this policy shift and the market's response to it played a big role in making these big investors change their mind and therefore also change how they behave. So fast forward to July, and Slock had dramatically changed his tune. Instead of predicting recession, he introduced a new concept: the Nike swoosh economy. Now, nothing to do with the stock Nike or trainers. In an interview with Yahoo Finance, he explained it makes sense to worry about the trade war. It makes sense to worry about immigration restrictions, deportation. It makes sense to worry about student loan payments. But overall, this is more like a Nike swoosh, not a recession, but a Nike swoosh. And my cat is very excited about that one, if you can hear that, is where we have a slowdown over the next several quarters, and then we start to recover again bigly. Think about Nike's famous logo. It's not a sharp V that drops and immediately recovers. It's not a U shape that stays low for an extended period and then recovers. The swoosh drops sharply, but then curves upwards in a gradual, sustained recovery. And that was a huge shift from his earlier predictions. But what caused the change? Well, the key factor It's the economy. The economy is stupid. Despite the headwinds, Slock has warned about several critical indicators, but they then showed more strength than expected. Consumer spending, robust, even with concerns about trade wars and high borrowing costs. And Americans are spending. You guys are spending, and you, American consumer, are like 60+% of your economy. You keep swiping that plastic. Thank you very much. We take the profits in the stock market. And then second, we have the job market. And it's slowing a little bit, but it's adding jobs. Unemployment ticked up slightly, right? 4.2%. Historically, that's pretty low. And then third, the initial impact of tariffs is just a lot less severe than feared. So there's no economic catastrophe. The economy has absorbed the shock. Now, who's actually absorbed it? I looked at some statistics from that today from Morgan Stanley. It's mostly American companies. They pay about 60% of it. About 16 or so percent is paid by the US consumer, and I guess the rest is absorbed by suppliers. And then we have where we are right now. This is important, right? So as I'm recording this, August 2025, the data tells a compelling story. The S&P has gained almost 20% compared to last year. It's up about 8% or so this year. And the market has recorded 10 all-time closing highs last month, which is just remarkable resilience considering all the crazy stuff that's going on in the world. But it's not just about stock prices. Let's look at a couple of key indicators, and you want to write these down. The bull-bear sentiment has been mad, volatile, as they say on Wall Street. And the investor sentiment spread, which is sort of a metric we look at, is turned negative. It's -8%. It was positive for just weeks ago. So investors are becoming a little bit more cautious. And that's also what I've been sharing in my weekly updates to my mentees. So I'm saying, like, the market's getting a little bit more cautious. Now, corporate profits have exceeded expectations across the board. I looked at it this morning. Out of 40 software companies that reported earnings, 40 beat expectations. And yeah, some people are saying that, Palantir is a little expensive. What's 500 times forward PE between friends? But overall, the market fundamentals are pretty solid. The rest of the world, or the monkey markets, well, they've actually outperformed the US this year. About 18% up in emerging markets, up. And Europe's up similarly, about 18% or so. So the global strength supports the idea that we're not heading into this world-ending recession as Bloomberg probably has you believe. They seem to hate absolutely everything that Trump puts out, which isn't great, by the way. You don't want your publishers to have a very strong political view. It muddles the picture. But anyway, the Fed. Well, the Fed hasn't been cutting rates, and the Donald is very upset about that. But while we're not going to get, we may get a rate cut, but it's at a pretty low rate, pretty low percentage chance right now. But we're probably going to get some towards the year end, and we're definitely going to get some in 2026 because this Fed president is out of the window with egg fried noodles, as they say in Hong Kong, where I am right now. Now, perhaps most importantly, the data, the economic data that worried Slock and his $600 billion, like the impact of tariffs, it's proven to be a lot more manageable. One source notes that tariffs are adding only about 0.2% to inflation, right? Massively less than expected and fairly irrelevant. So what does this new Nike swoosh recovery then mean for your investment strategy? Well, if this chap's right, and the $600 billion are right, then first, the market's going to keep being a little volatile, a little choppy. It's not a completely smooth sort of a thing. There are going to be ups and there are going to be downs, especially in August and September typically. But the environment we're in favors quality companies. So strong balance sheets, steady cash flow, right? The good businesses. And he's saying, look at things like healthcare, utilities, telecommunications, because they can weather economic uncertainty. And then third, patience will be rewarded. So it'll take a little bit of time for these stocks to really, really go nuts. And some of the stocks that I'm looking at this week and probably in weeks to come, again, we're looking at some defensive things. We're looking at utilities, electric utilities particularly. We're looking at aerospace and defense companies. We're looking at semiconductors. There are some really great sectors that are attracting a lot of money. And that's all I really ever care about. It's like, where the heck's the money going? Which is why I listen to people who've got $600 billion under management. Now, does everybody agree with this optimistic scenario? No, of course, there's some analysts out there who haven't taken their uppers and they're seeing recession risks, right? JP Morgan maintains a 40% probability of a recession. Now, earlier this year, it was 60%. And note what they do. They put it between 40 and 60%, and they move around, and it's basically coin toss scenario, right? They haven't got a frickin' clue. So don't pay any attention to those goons. But the key lessons here from Slock is you got to remain flexible and data dependent, as I say, because as investors, we can't predict the future with total certainty for like months and years to come. Whether we get this beautiful recovery the way it's presented or, something else falls apart, the principles that we use continue to be the same. We follow the money. So if everybody's buying aerospace and defense companies, we're buying aerospace and defense companies. Well, at least me and the kittens. And if everybody starts loving, I don't know, some sort of random utility or some sort of sector at the moment, Ethereum, crypto, whatever, everyone's loving it. So we're taking part in it. So you don't need to develop these sort of long-term convictions about, well, I think the only company in the world that'll make money is, whatever. And then pin all your hopes and all your money on that thing to get you to your freedom and your retirement and your financial freedom. No, just be smart about it. Just follow the freaking money. And if you want to learn how we do that, I'll actually give it away. Like, I'll link down below, felixprehn.org/get-free, and I'll give you that away. But I paid like a couple of $100,000 to learn from my mentors and many, many years of like trial and error. So look at some more defensive sectors. Gold. Maybe have a look at silver. I'm not telling you what to buy. Just have a look at these sectors. Start understanding this a little bit. If the economy goes into recession, quality stocks tend to do well. We get those rate cuts. The rubbish, the leftover rubbish from the .com bubble is going to do really well. Your lemonades, your plugs, all that kind of stuff, they're going to do well. But also just bear in mind when you see one of these doom and gloom headlines, the US is the most dynamic economy in the world, right? And I'm quoting here. That's literally what Mr. Slock says. The Mag 7 to AI tech giants are just incredible, right? And that's also why I don't think the dollar is going to completely collapse, because the world wants to buy these companies. They need to buy dollars to do it. So if you are worried about the economy, or if you're worried about stagflation, focus on the quality assets, right? They tend to do well. Companies with very good ROIC, return on invested capital, that's a good thing to look at. If you've got a bit more risk tolerance, then, I think biotech is going to have a nice uplift here. But it really depends on where you are, how close you're getting to retirement and all that kind of good stuff. And that's why it's important to learn and maybe have somebody to learn from. It doesn't need to be me. I'm not saying that by any stretch of the imagination, but you kind of want to have somebody to bounce your ideas off who's been here a little bit longer, right? So let me know in the comments down below, what are you preparing for? Is it the crash or is it the massive Trump comeback rally? And try not to put your politics into that. It's not going to help you very much. I'd love to see how people are feeling, and then we can give you some more information and content and research on what's most useful for you. If you got some value out of this one, well, imagine the value you'd get out of just 15 minutes of pure unadulterated education. Check it out, felixprehn.org/get-free. Links down below. All the best. Just as President Trump officially signs an executive order allowing Bitcoin and crypto into your 401ks, imagine having Hugh, who just discovered a stock that could explode 100x, according to its CEO, as Ethereum.